How's it going? We'll talk about mortgages and ways to try to get better rates on your mortgage. A mortgage is an agreement between you and a lender that allows you to borrow money to purchase or refinance a house. If you fail to make those payments, they're going to take it from you. The rates, the interest rate, the higher the interest rate, the higher your payments are going to be. And the lower the rates, the lower the payments will be. The first thing is a credit score. All right, so you want to get the higher your FICO score is, the lower your interest rates will be in return. My wife, who is sitting across from me, who doesn't want to be in this video, is going to tell you some ways to get a higher FICO score. Go ahead, honey.
Make sure you pay all your bills on time. Pay any balances that you have that may be past due. Check your credit report. Make sure there's not any inaccuracies. Make sure everything is accurate that's on there. If you have any credit card balances or high balances to any of your creditors, you might want to go ahead and pay those down as soon as you can.
All right. Employment and income stability. All right, so lenders prefer to see candidates who have had a job and had the same job or moved up in their career for 2 years. You want to at least have a job and have income for 2 years, and in that 2 years, either stay in the same position you're in or move up the corporate ladder. They're going to check this by checking your tax records. They might want to see pay stubs for 12 months, 24 months, who knows. So it's better to try to stay in the same job for at least 2 years before you try to acquire a mortgage. Debt to income ratio, or DTI. This is a measure of a total amount of monthly minimum payments divided by your stable monthly gross income. That's what they call the back end of this. I'm not going to explain the front end too much. Historically, banks want to see, minimum payments divided by your stable monthly gross income. Historically, banks want to see 36%, depending on the type of mortgage you're getting. So pretty much keep your debt down. Try to keep your debt way down. Pay off the credit cards, like we said before. It's good to have your cars paid off, and this will look better. Might get you a lower interest rate on your mortgage. Anything you want to add to that? No. All right. Down payment. All right, so you can get a 5% down payment, and get a house with a 5% down payment if it's your first-time homeowners, first-time home buyer. The 5% is considered to be more risky than 20%, and because it's more risky, it's going to come with a higher interest rate. So if all you can come up with is 5%, all right, whatever. But if you can come up with the full 20%, the bank will look at that like it's nowhere near as risky, and you'll get a lower interest rate in return. Cash reserves. All right, so the banks want to see, well, cash reserves are measured in the number of months worth of house payments you can have saved in cash. The reserves can include checking accounts, savings accounts, money market funds, or certificates of deposit. Don't think your retirement fund is going to work out good enough for that. Because if you take out something if you have to end up having to cash out a 401k or an IRA or something like that, there's going to be penalties. And because of the penalties, it ain't looking too good to them, because I guess they don't want to do the math on what the penalties are. I'm not 100% sure why not, but it's just not considered to be a safe form of holding your cash reserves. All right, so anyway, that was my few little things on how to get lower interest rates. Like, subscribe, share. I'll be talking to you real soon.